Hi, my name is Jules, and welcome to our channel segment where we talk about investments, stocks, cryptocurrency, and more money-making topics. If you are new to our channel, Investing Wise Academy, click subscribe button so you will never miss a financially informative video. Today's video is for new investors who are just getting started in the stock market, as it can be difficult to navigate these murky waters if you don't know what you are doing, which is why we're making a video about it. We want to give you a framework to help you navigate this, shall we say, interesting times without getting burned. It won't turn you into an investing genius in a single video, but it will put you on the right track to investing well in volatile times. We're going to share with you 5 Buffett tips that we use. They are used by the best investors to beat other investors and win in the long run. Let's get started. Tip number 1. Control your emotions. Ready for a cash. Those who can handle emotions will be one of the things that separate the average investor from the quality investor during these times. At a relative's funeral, Jordan Peterson advises that we be the reliable ones. We must apply that advice to investing, particularly during and after market crash. This is, after all, the mindset that 90% of investors adopt. They are overjoyed when their stock prices rise. They go to the bar and tell their friends how much money they made. They monitor their stocks on a weekly, if not daily basis. Their emotions are all entangled in the stock market's ups and downs. The small percentage of investors who succeed are those who do the exact opposite of what these guys do. When a stock's price falls, investors benefit because it means the stock has become cheaper, allowing them to buy more at a lower price. They understand that the lower the price at which they purchase stocks, the higher their long-term returns will be. You're dealing with a lot of silly people in the marketplace. It's like a great big casino and everyone else is boozing, Buffett says, referring to this exact concept. Buy low, sell high. Unfortunately, most investors do the opposite. Tip number 2. Choose an area that you are familiar with. If you want to have an advantage over the investors and earn high returns, you should invest in your areas that you are familiar with. So, I recommend that you take a step back and evaluate the areas that you are familiar with. If you're a young man, it could be gaming, artificial intelligence, social media, or a technology-related company. If you're older, you may have an advantage in more established businesses, maybe hospitality, travel, wine, food, or something along those lines. You know Buffett, he only invests in more established business models that he is familiar with. See's Candy, for example, sells sweets products and has a long-standing business model that Buffett understands. Or the likes of insurance, which Buffett spent many hours getting his head around. He is so knowledgeable about the game that he can identify companies that are good investments. And you should be doing exactly what Buffett is doing. As I previously stated, if you're young and enjoy gaming, you probably know more about what companies will be leading in the future, what industries will prosper. That's why one of Peter Lynch's most famous quotes is so straightforward but so profound. Know what you have and why you have it, he says. Most investors, after all, want to profit in any industry. They want to discuss all of their businesses with their friends at the bar. However, they rarely go it alone in their fields of expertise. They rarely know what they have or why they have it. That is why you should not follow in the footsteps of that majority of investors. And speaking of familiarity, you may subscribe to our channel so you could be familiar with some investment strategies and tips like this. You could also add this video to your playlist so you could always watch these tips for beginners in investing in a stock. Tip number 3. Learn the game first. If I just got a random person who had never played poker before and said, "Do you want to join me and my friends for a game of poker? We'll each put in 500, that person would be stupid if he said yes to the game because he'd never played before and would lose money. If we apply that to the stock market, you'd be surprised at how many novice investors don't understand the fundamentals of investing. As a result, they end up getting creamed after 1, 2, or 3 years. If you're new to stock market investing, especially in these risky times of 2022, here are some fundamentals to understand. One of the most important metrics to understand is the PE ratio. It calculates how much you pay for a stock concerning how much it earns. Another factor is return of equity, which is a useful metric for determining how profitable a company is. How well do you understand stock market orders? What does limit order entail? A market order perhaps? A stop limit order perhaps? Before you invest, you should be aware of this following. You know, you have a good grasp of variety of fundamental strategies, such as Warren Buffett's value investing strategy of buying at a discount to intrinsic value. Do you have any experience with a dividend aristocrat strategy? It's a collection of stocks in which you can dollar cost average and, according to history, outperform the market over time. Before you become an investor, you must understand these fundamental strategies, these small tactics that can help you understand PE ratios. Tip number 4. Ignore the minor details. One of the easiest rules to invest in, but one of the most difficult to follow. Most investors are obsessed with stock market news on daily and weekly basis. The thing is, every time you get a price of news, you get a dopamine rush. As a result, 90% of investors are fixated on the stock market short-term fluctuations. We wouldn't problem with this, but it harms the way you invest and ultimately your investment returns. One of the drawbacks of looking at the very short term is that you miss long-term patterns. If you look at the stock market for a week or even a month, you'll usually see tiny dots of a long-term pattern, so if you're attached to that short term, you'll make decisions based on that, which will result in lower investment returns overall. This is why Warren Buffett advises buying only what you'd be happy to hold for 10 years if the market crashed. Don't be concerned about the daily news or the minor details. Tip number 5. Know your market cycles. The next thing you should be thinking about, especially in 2022, is market cycles. I'm referring to learning which stocks performs well during which periods. Let me share with you an old school graph that will assist you in doing so. As you can see, transportation technology and capital goods stocks perform well during the early to middle stages of market cycle. Why? Because the economy is heating up and things are starting to expand, transportation is becoming more important. During these times, technology stocks are frequently on sale for a bargain and they have potential to skyrocket in value. If you bought Netflix, Tesla, or Amazon 10 years ago, you did so just as the market was heating up. However, as the cycle progresses, more conservative stocks such as consumer non-cyclical and healthcare begin to outperform. So, what gives? Because people still need to eat, toothpaste, soap, and clean water during a market downturn, consumers non-cyclical are safer to own. They also require medical attention. As a newcomer to the stock market, you must first understand this concept. You must understand which stocks perform well and when. You can buy the strongest stock in the world, but if it's in a bad sector, you'll lose money. One of the reasons we like to follow Ray Dalio at Investing Wise Academy is because of this. He provides historical evidence and connects it to current events to help us understand where we are in the market cycle so we can better organize our portfolio for market conditions in 2022. So, if you are a new investor, I'm sure you wish you had started 10 years ago when the economy and market were still in their infancy, but at the end of the day, all we can focus on is the current market conditions. And these little tips that we've shared with you, they're going to help you navigate the waters of the unique market conditions in 2022 and going forward. Before we end this video, please comment below on which tip imprints in your mind. Once again, I'm Jules, your segment host for investments, stocks, cryptocurrency, and more money-making topics here in Investing Wise Academy. Subscribe and click the notification bell so you can catch up with me in our next video.